Today, we're diving into AeroVironment Inc. We are looking at a stock that, well, it really demands investors believe in the future of defense technology, maybe while ignoring some present-day profitability issues. The market is pricing this thing for perfection, so the central question is this: does the company's dominance in defense robotics justify its extreme premium valuation, or does the financial data and maybe some insider behavior signal that a painful correction is coming?
And that conflict it's defined by numbers that just do not sit well together. On one hand, you have powerful institutional conviction. Ownership is high, 63.78%. But then you have the stock trading near $257, while multiple, cash flow-based models suggest it's massively overvalued, placing fair value closer to, 166 a share. Wall Street's target is soaring past 400, but management's own actions, they suggest a profound lack of conviction in that upside. That's the tension we need to unpack.
I'll grant you the numbers appear to conflict on paper, but that assumes this is just some standard industrial firm. AeroVironment is a pure-play technology leader, and it's positioned squarely in what many are calling the defense tech supercycle. They don't just manufacture, they innovate in three critical segments: uncrewed systems, loitering munition systems, the LMS, and MacCready Works. And for those unfamiliar, MacCready Works is their advanced R&D arm, focusing on high-margin next-gen systems like directed energy. This is exactly why the market is so forward-looking, and the sales growth, it reflects this. Year-over-year sales over the last 12 months expanded by a staggering 44.04%.
That robust sales growth I agree, it's undeniably impressive. But growth at any cost is not a sustainable investment thesis. When we look beneath that impressive top line, the story shifts, and it shifts drastically to one of financial fragility. The company is currently unprofitable. It's reporting a net income of negative $44.92 million. That results in a negative operating margin of minus 0.87%. So that $12.87 billion market cap is resting entirely on speculation. It's just not backed by current profit generation.
The valuation metrics are admittedly high, sure, but they reflect the substantial competitive advantage the company has built through perpetual innovation. This is about establishing a technological moat. They hold proprietary technology that the military depends on, like the patent for their operating control device for an unmanned aerial vehicle. Their proprietary systems, like the Switchblade, are now basically standard equipment in modern conflicts. The adoption of these systems guarantees long-term revenue streams. We're talking decades. Furthermore, the short float stands at 6.33%. Now, this provides significant short squeeze potential. Any major contract announcement could trigger aggressive covering and rapidly push the stock toward that $400 consensus target.
The allure of a short squeeze is tempting. I get it. But it's a short-term trade. It's based on market mechanics, not a long-term investment decision. We have to confront the reality of the price. The core valuation multiples are truly excessive. The price-to-sales ratio is 11.86, and the forward P/E is 56.24. That level of pricing already assumes perfect execution for the next 5 years. And when analysts apply standard discounted cash flow models, the outcome is, it's alarming. Alpha Spread's base case puts the intrinsic value at roughly $166.66 per share. This confirms a significant overvaluation. It signals that the current market price is, it's divorced from what the enterprise is actually worth today based on its cash flow.
That analysis, however, it fails to account for the unique reality of scaling a high-growth defense tech firm. The negative earnings aren't a business model failure. They are characteristic of a company that is aggressively prioritizing R&D and market share in a critical sector. These investments today are what solidify those multi-decade contracts tomorrow. And crucially, they have a very healthy balance sheet, a low debt-to-equity ratio of 0.19. This gives them the firepower to execute on strategic expansions. The market sees this and is projecting high EPS growth, 21.82% over the next 5 years.
Okay, but that strategy rests entirely on extreme customer concentration. The vast majority of their revenue comes from a single customer base, the U.S. Department of Defense and its allies. This exposes the company to severe geopolitical and budget risk. If Congress slows defense spending, the entire revenue stream is immediately in jeopardy. Moreover, their core operations are not generating positive free cash flow. The P to FCF ratio is negative. This means they are relying on things like public stock offerings to fund growth, like the major acquisition of Blue Halo. Funding growth by selling stock at these highs is simply shareholder dilution. It's not organic cash generation, which should deeply concern long-term holders.
Growth through acquisition, especially in defense tech, is a necessity to maintain their edge. The Blue Halo acquisition expands their total addressable market into areas like directed energy and space assets. So this isn't dilution for survival, it's prudent long-term strategic capital allocation. The market rewards that kind of foresight.
Foresight should be backed by the people who know the most. I mean, if management truly believe the fair value is heading toward $400, they'd be buying stock, not selling it. We have to look at the smart money here, the insider activity. Insiders are consistently taking chips off the table near these all-time highs. We have the data. CEO Wahid Nawabi, he sold 17,300 shares worth $4.55 million on July 16, 2025. The CFO, Kevin Patrick McDonald, sold 513 shares for over $170,000 on November 10th. The overall insider transaction figure is minus 0.16%, and while that seems small, it's the pattern of selling at the top that signals a clear lack of conviction from the people who know the most.
Hold on. I'm not convinced by that. Those sales are likely scheduled, related to compensation, and they are minimal when you compare them to the overwhelming institutional endorsement. Institutional ownership is exceptionally strong at 63.78%, and more importantly, we have seen a net positive institutional transaction change of 6.57%. This is massive accumulation. And we even see confirmation from Washington itself. Congressman Gilbert Ray Cisneros Jr., a Democrat, reported purchasing stock in the $1,000 to $15,000 range on October 3rd. When the people who oversee the defense budget are personally investing, that's a powerful signal that outweighs routine profit-taking by executives.
That political buy-in, while interesting, it just underlines my core point about concentration risk. The company's viability relies entirely on access to government bureaucracy, and that access comes at a high price. We see it in their escalating lobbying efforts, all focused on defense. They spent $170,000 in the quarter ending October 20th and $190,000 in the preceding quarter. This isn't generalized policy work. This is targeted spending to ensure their systems stay embedded in budget lines. It's a persistent headwind. And we also can't just ignore the baggage this company carries. The ongoing securities class action lawsuit, filed in late 2023, alleges that executives previously made misleading statements about projected growth. This isn't just litigation. This alleged misrepresentation led to a stock price drop of nearly 30% in a single day back in late 2021 when they cut guidance. That 30% drop isn't ancient history. It's a clear precedent that tells us exactly how this market treats disappointment from AeroVironment.
That risk history is fully acknowledged by the market, I think. But the current strength of their product portfolio mitigates that past volatility. Let's focus on the near-term catalyst that is set to validate the bull case. The next major inflection point is the Q2 fiscal year 2026 earnings call scheduled for December 9, 2025. The market is focused on guidance, especially after recent contract awards like the $95.9 million LRKI award. A positive guidance revision will serve as the confirmation needed to reaffirm those $400+ targets.
Because the stock is already so richly valued, if they fail to deliver flawless performance, or if margins continue to be negative, that historical volatility will resurface. That $166 intrinsic value will look less like a warning and more like a magnet. The market will punish any deviation from the hyper-growth narrative.
My conviction remains that the market is valuing AeroVironment correctly as a cutting-edge defense tech provider. Its proprietary, indispensable position in the future of warfare provides a competitive moat few others possess. The strong institutional accumulation confirms that smart money recognizes the leverage in their portfolio. The consensus price target reflects that high anticipated EPS growth of over 21%.
This is an essential defense asset, and the valuation reflects that scarcity.
And I believe you are paying a massive premium for an aspiration. The data shows significant quantifiable risk. The valuation models suggest extreme overvaluation. Insider selling near highs indicates a lack of management faith, and the escalating lobbying costs highlight the fragility of their revenue base. If they succeed flawlessly, they justify the price. If they stumble even slightly on December 9th, the downside, potentially back toward that $166 reality, is significant.